Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, August 27, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And there's a lot going on. There's a lot we have to talk through. There was no video after Friday's close. We did have a big up day on Friday. So let's reel back the tape a little bit. Let's discuss what happened leading into late last week and then where we go from here and what I think the bigger picture has in store for us. Because as we look at other markets, I'm going to show you a couple of things that I'm looking at that are potential canaries in the coal mine, but we're going to begin discussing these things. Nothing that we're going to discuss tonight is likely imminent, and when I talk about that, we're going to be talking about the market making what I'll call a topping process, but the market's still going up, so let's not jump ahead of ourselves. Let's talk about where we were late last week, where we are now, where we're going, and then we'll begin talking about the bigger picture. There's a lot to discuss. I have a lot of notes. If we get through even half of the notes, we're going to be doing fantastic. Before we get started in earnest, let me pause and just thank everybody for continuing to participate, making important posts and comments underneath the videos. I love the participation, very smart comments, interesting information. Please keep up the great work. It's very, very beneficial for me and the entire community, so please continue to do so. In addition, hit the like button on the video and share the video with those people you think can benefit from this information. All right, so last week we put in what could have been a topping tail, a doji candle. It was certainly in the time zone, if you will, in the wheelhouse where we could have seen more of a pullback than we did. The market began, and when I'm talking about that, I'm talking about this candle right here. So when that candle was put in, we certainly could have went down a little bit farther than we ended up going down at on the market or in the market. So what happened was we began going sideways, and I told you guys when it happened that I took a short position and that I would be short against the high of that candle. I ended up covering that short position on Friday for actually a small loss. When the market was reversing, I saw the writing on the wall. We were headed higher. Instead of going down off that so-called doji candle, what we were doing was we were just going sideways for a couple of days, and the trend higher was continuing. And I said at the time, it wasn't the greatest shorting opportunity in the world. I was going to have a tight leash on it. I kept a tight leash on it. I turned it around and actually went long the market, and I know I'm going to have those people out there that don't believe the trade. So I took a snapshot of the trade. Here's a snapshot of the trade, and you can see all I did, and I actually bought two different strike prices. They were actually different in time, just in case. So it's called a time spread. So you can see here, I did a little bit of a stutter step. I bought it. I only bought 10 calls. Okay, I bought the calls, I sold the calls for a profit. Then going into the weekend, I decided I wanted the calls again. So I bought them, and I also bought a different strike on a different expiration month. So I actually had a total of 20 of these calls, and it paid nicely. And that point is that I saw the breakout coming leading into the week before Labor Day weekend. It's unlikely we're going to see the market collapse. We're very, very close to the big psychological level of 2,900 in the S&P, 290 in the SPY. That's where we are about now. We weren't there when obviously Friday occurred, but we were approaching, and this is the melt up. I've been talking about a vacuum, and obviously we've had some stutter steps along the way, but nevertheless, we're seeing the vacuum. This is a melt up, and that brings me to another topic that I wanted to discuss. The topic is, where does this end? Is the return coming? And is there going to be a play on the downside? And the answer is, of course, yes. The hard part is, where is the turn coming and when is the turn coming? The when is the turn coming, I'm going to take a crack at pinpointing and say, and we can't get too narrow just yet, we have to see a turn occur. But I'm going to start looking for a turn anywhere between now, and I'm not expecting it like tomorrow, but now and let's say 4 or 5 weeks from now. So we have Labor Day coming up. Labor Day, it's unlikely we're going to get a turn before Labor Day. We're more likely to trade up higher into Labor Day, into the 3-day holiday weekend. Next Monday is Labor Day here in the U.S. The markets are closed. So it's likely rather than unlikely that we trade higher into Labor Day holiday weekend. So sometime after Labor Day holiday weekend, we're going to be looking for signs and a signal of a trend change. It's not to say we can't go higher in the short term. We can, and I think we will. In fact, I think there certainly is another 15 to 20 S&P handles on the upside in the cards until this is finally said and done at a bare minimum. But we don't have to worry about exactly how many. What we have to worry about is identifying when the market is telling us it's making a turn. It may take 2 or 3 stabs at it, but we're looking for signs and a signal of a trend change. We obviously don't have that today. The market is making higher prices. Let it continue higher. The trend is your friend until the very end. I couldn't say that enough times. I've said that each and every night for many, many, many videos in a row. But now we're getting, on a short-term basis, a little far extended away from home base. Doesn't mean we can't go higher, but likely we're going to have to at least go higher, or pull back, or go sideways for a little while, let home base catch up to price a little bit, let price come down a little bit toward home base. That's the likely scenario, but again, we can still go higher before that occurs leading up into the Labor Day holiday weekend. Nothing says we can't continue to go higher. The volume is light. In light volume, what do we always say? The trend is your friend in light volume. The path of least resistance is higher, so you put those two things together, and I wouldn't necessarily want to be short in the face of this market right here. Just keeping our eye on the SPY weekly chart, the trend is obviously higher. We are significantly extended from the weekly 20-period moving average or home base. Eventually that will change, but it's Monday, so we're not concerned today with the weekly chart. We just want to know and understand that we are in a very strong uptrend. So even when and if we do pull back at some point in time in the spiders or across the markets, we have to understand what we're really looking for. We're not looking for an all-out collapse. We're looking for corrections along the way in an uptrend. When and if, ultimately it will be, but when this uptrend is broken from a weekly chart perspective, that's something entirely different, but that's not going to happen anytime soon in the spider. But as long as we're aware from a longer term perspective, and when you look at this, nobody should be surprised when we see days like today. We have a gap higher on a Monday and we just have a gap and go, and the market never gave anybody an opportunity to even get in on a pullback. When you look at, for example, the intraday 10-minute chart, we had a gap higher, we inched higher, and then we just went sideways all day. The market had minimal pullbacks at best. Didn't give anybody a chance to get in the market on any kind of significant pullback. So now that we've gone to a shorter time frame, let's see what's in store in the short run. What's in store for tomorrow? Well, you see the 10-minute chart. Let's look at the hourly and take a look at what we think we have in store. On the hourly chart, we've basically gone sideways, consolidating at the upper end of this upper range of new highs. And is that telling us that higher prices are coming? Under normal conditions, yes. Just understand that at some point, the market will make a consolidation pattern at highs and it will fail. That's the way it works. Eventually, at some point, highs will fail. I'm just not so sure we're at that point right now. So right here, the market is, or at least the spiders are telling us, higher prices should be likely leading up into Tuesday's session. Let's go over to the IWM. As you know, the IWM is my favorite market leading indicator, and the IWM could be a potential, and it's early to tell, but it could be a potential canary in the coal mine. And here's what I'll say. The IWM chart looks slightly different than the others. It's obvious when you look at the chart. you can see what looks like what I like to call a pseudo doji candle. You could make a case it's a topping tail. It's interesting. It's not definitive just yet. Let me explain what I'm looking at. Again, once you get inside my head, just please understand it's a dangerous place to be. First thing is, we're in an uptrend. We're significantly above the moving averages when you look at the daily chart. If you want to look at the weekly chart, just to reinforce that, you can see we're significantly in an uptrend. So we have to just understand that today is one day of trading activity. It doesn't mean we can't blow through today's high tomorrow. So we need to understand that. Could one be short against today's high based on the type of candle and activity today brought? Well, one could, but let me just throw something else at you, which is going down to a 60-minute chart. I want to see all sides of the market. I want to see multiple different time frames. So we know the long term, the trend is up. We have an interesting, maybe a suspect candle on the daily chart. And when we look at the 60-minute chart, can we explain the candle on the daily chart as maybe an anomaly? And it's possible, and let me explain this one. So the market makes a high, and we begin to pull back in the IWM. We pull back all the way to the point where we actually fill a gap, and then we bounce off that gap. Here's the gap we filled. We bounce off the gap, and could this, based on the hourly chart, just be something other than, or nothing other than, I should say, a pullback pattern? We have an up move. Here's a pullback pattern to fill a gap, and now we once again can take off to the upside. And that certainly is a possibility. So when you look at the daily chart, you say, yes, interesting candle. We are extended from home base. The 20-period moving average is home base. It certainly wouldn't be out of the ordinary to get a garden variety pullback in any of these markets when we do get short-term overextended, and we are, and an argument can be made that we can be and certainly can have a pullback, but the market can remain extended for longer than people think it can most of the time. So there's nothing that says the spider can't go higher. There's nothing that says the IWM can't go higher. But here's what I'm watching, and here's why I say it can be a canary in the coal mine. I want to see what happens now from this point forward in the IWM. Do we do a retracement of today's high, and then do we fall away again? That's going to give me more information. At the same time as something like that, hypothetically, of course, can be happening, what's the spider doing? Is the spider making an interesting or suspect daily candle, for example? What's the NASDAQ doing at that time? What are other markets doing at that time? So right now, it's a puzzle piece. I'm not necessarily taking action on it yet because of what I showed you on the hourly chart, but it's interesting. It's a puzzle piece. I'm putting it on the table. I'm aware of it. We're in an uptrend, so I have to look at both sides. I have to acknowledge the bullish case, but I'm also acknowledging that we're eventually going to see a canary in the coal mine surface. Can this be it, or can this be one of them? Yes, it can. It's a puzzle piece. It's on the table. Now, here's a chart of the VIX. Now, why do I bring up a chart of the VIX? Well, I can make a case the VIX is bearish, below all the moving averages, but also when we looked at the VIX last week, and I discussed with you the fact that as long as the VIX holds this low, we can make a case that this could be a pullback pattern. So we have an up move, a pullback pattern, and I said at the time, doesn't necessarily mean this could be one of those classic ABC patterns where we have to complete above this high. It could just be a pullback pattern that brings the VIX higher, back up into some of these other moving averages. Right now, we're below all the moving averages. We can get above the 20, into the 50, maybe even into the 100. Once again, we'll see. It was interesting then. It's interesting now when we look at the IWM and we see, for example, the VIX up almost 1.5% today. It's not a big deal, up only 17 cents, but on a day when the SPY was up $2.30. The S&P 500 was up 22 points. The Dow, which closed above 26,000, by the way, a milestone, was up 1%. The VIX was not down. The VIX was up. So somewhere along the line, somebody, for some reason, is buying protection while the market's going higher. Again, these are the type of things that don't necessarily have to culminate the following morning, but these are the things that you want to gather as data points on whether it's a bullish case or a bearish case. These are the puzzle pieces that get put on the table, and these are what help build the case for trades, whether they're day trades, whether they're shorter term swing trades, or longer term positional swing trades. These are the things that we have to look at day in and day out. We have to be aware of. We have to note. We have to put them down on both sides of the page, if you will. These are all puzzle pieces. The VIX is certainly a puzzle piece right here, right now. Now, the transports had a nice, healthy up day, pretty much up over 1%, pacing the rest of the market, give or take, depending on which market you want to look at. So, not out of the ordinary. Again, my second favorite market leading indicator. So there's nothing out of the ordinary for the transports. Can we go higher? Yes, we can. If the rest of the markets are pulling higher, a rising tide lifts all boats. Don't be surprised to see the transports pull higher as well. We're in an uptrend. No new information in the transports. When we look at the Qs, now the Qs are at a new high, obviously. Now, we talked many times about the fact that when the Qs closed above this breakdown candle from July 27th, when we closed above the high from that breakdown candle, that was the signal that higher prices were likely. So what happened from there? The Qs, we went back up here. We closed above that high. So here's that high. So we had an up move. We had a pullback pattern. And then we have the ensuing up move, the continuation move. So that played out as we designed it and discussed it for many days and even weeks. The question is, how high do we go in the Qs? Well, we're not going to guess when we're at new highs where the all-time high, if it's going to be, and I'm not suggesting it's going to be an all-time high. I should take that comment back. We don't know about all-time highs, when they're ending and when they're not. We'll decide that when we see a monthly chart and we see a longer-term trend change. But until and unless something like that happens, we're just going to use the term a high being put in place, and it could be a daily high, and it could be at much higher prices, or it could be at slightly higher prices. Again, very similar to the spider. We're going to be looking for, over the coming weeks, let's say, signals and signs of a trend change. But here's what I want to point out. I want to just take a little side note here, and I want to look at some individual stocks, particularly the FANG stocks, that are overweight in the Qs, and then I want to have a discussion about what I think is developing. So here are the Qs at an all-time high. You have Amazon at an all-time high. It's an absolute monster. You have Apple pretty much at an all-time high, minus a little pullback. But for the most part, all-time highs, very strong stock, monster. Facebook has some trouble. Facebook is nowhere near at an all-time high. In fact, when you look at a weekly chart in Facebook, what you can see here, and traders that have taken my course at Lazy E-mini Trader know exactly what I'm looking at and what we're looking at in Facebook. So Facebook doesn't look the same as Apple, Amazon, and the Qs. So that's interesting. So let's go back to the daily chart and we'll look at Netflix. Netflix, we're not finding at an all-time high. So that's interesting. So we're starting to see some divergences occur between the FANG stocks, which overweight the Qs, and the Qs themselves. So we'll talk in a second about what the meaning of that could be in both directions. We have to always look at both sides of the market. I can make a case both ways. Google, not at an all-time high. So that's another one diverging. So we know that Baidu is part of the index, not anywhere near an all-time high. Alibaba, nowhere near an all-time high. And there's more. We can look at Tesla, nowhere near an all-time high. There's a lot of news surrounding Tesla, but nevertheless, not anywhere near an all-time high. So here's what I'll say, and we go back to the Qs. I can make a case both ways. So on one hand, I can make a case that there's a lot of other stocks making all-time highs in the Qs that are pulling the Qs up to all-time highs, despite the fact that the overweighting in the FANG stocks, and you can see the divergences of some of the top stocks in the top index, the top stocks in the Qs, you can see the divergences. You can say that there's other stocks making up for those divergences. And then I can flip it around and make the case the other day, or the other way, that we're starting to see some divergences occur, and we're likely to see more of them occur. And this is how we use that information. We take the information, it's another puzzle piece on the table. We continue to watch for those divergences and potentially others. We watch the Qs, we watch for signs and a signal of a topping signal or trend change, and we look for all these things together. They don't necessarily and won't necessarily unfold at the same time. They'll unfold one at a time, and then it will become evident what is happening. And therefore, over the next several weeks, I'm looking for signs and signals of a trend change that'll be a correction in the market, not a catastrophic correction, a correction in the market. May or may not turn into something else. We'll worry about that at the time. In the meantime, I'm happy to play the market in both directions. I'm happy to be long for higher prices with the full and complete understanding that I have exit points. I have an exit strategy. And it's unlikely that I, for one, am going to make the market go to the last tick in order to get out of my positions. I never do that. I'm happy to take the profit when the market hands it to me. I like to sell into strength. That's what I teach. And I like to practice what I preach. Moving on to the broker-dealer index, you see a very, very strong up day, over 1.5% up in the broker-dealer index. Remember, we made a double bottom. We talked about it at the time. We bounced off the double bottom. We made a consolidation pattern. And look where we are now, closing above the 50 and 200-day moving average on the XBD. Very strong showing. When we look over at the XLF, look what happened in the XLF. We talked about this ad nauseum. We made a high in the XLF, and then we had a pullback. And I know I had some doubters out there that were calling for much lower prices in the XLF, saying that the highs were in. And I said, well, it looks like just a pullback. We went into the moving averages. We went and we made in certain amount of time, very specific period of time, the market made from pivot top to pivot low, took off again to the upside, got back above the moving averages, and we had a nice rally higher today, making a new recent closing high in the XLF. That's important. I always stress the fact that without the financials participating on the upside, it's unlikely we see significantly higher prices across all the equity markets on the upside. And the same thing applies on the downside. If the financials are weak and they're melting away, it's unlikely that we see the stock market in general have higher prices across the equity market indexes. We've been discussing the financials. Here you have, again, recent highs for the financials that bodes well for the equity markets at minimum of in the short term. Again, we're going to have a pullback. The markets don't just run away, make new highs day after day, week after week, month after month without pullbacks along the way. The question is, we have to be able to identify where the pullbacks are occurring, and we have to have high probability trades, and we have to know where we're wrong in those trades, and that's the way you stay profitable in this business. Not making uneducated guesses, but making high probability trades with very defined risk. That's how you find success in this business. So when we look at the SMH, for example, we see a strong day on the upside in the SMH, but we did find resistance, and I will say natural resistance, at this recent double top area. And you can see what happened. We had what's called a price rejection at that double top area. That's also an interesting area because we have the high of a former breakdown candle at the same area. So what that area is telling us, what this price level is telling us in the SMH, and remember, we always look at each market independent of one another. So just looking at the daily chart of the SMH alone, we see that there is a lot of overhead resistance where we are. We tried to get through it once. We're severely rejected. We're making another run for that area. If in fact the SMH is able to close above the high of that breakdown candle, 109.50, that's going to be important for the SMH. We've talked about this before. That's going to send the market right up to, likely, and not necessarily in one day, but right up to 112 in pretty short order, which will represent a new set of challenges from an overhead resistance standpoint. But again, here's another puzzle piece for us. Look at the daily chart. We still have until proven otherwise, and at some point we may be proven otherwise, or this analysis will be proven otherwise, but we have a high, we have a lower high, we still have lower highs, okay? Now we can still push up, but if we don't close above this high, that's still going to be a negative for the SMH. And when we just pull back the curtain a little bit and look at it from a weekly chart perspective, we can make a case that we put in a weekly pseudo doji candle. I can make a case for one of those. And we've had nothing but a long drawn out, just sideways bearish consolidation pattern that will ultimately fail, or not fail in terms of the pattern, but the market, the SMH, will fail to the downside. But keep in mind, again, weekly chart above the moving averages. That's bullish. Okay, daily chart above the moving averages. That's bullish. I just want you to see what I see, get inside my head. Again, dangerous place to be, but I'm looking short term, I'm looking long term. I want to see everything. I want to see all these charts, all these markets from a global perspective. I want to know what I'm up against. I may see a really, really good short on a chart, but when I look at the time frame, one time frame higher, for example, I just don't love the short anymore, so it doesn't necessarily confirm, or it won't confirm the trade for me. I want to know those things. That's why I like to look at, and that's one of the reasons, I shouldn't say that's why, that's one of the reasons why I like to look at a bunch of different time frames. Switching gears over here, going over to gold, look what we have in gold. So we did have a bottom. We had a significant downtrend. I wasn't touching this with a 10-foot pole. I said we had a bottom. We talked about the fact that any trader who wanted to be long could have done so against the low from the 16th of August. We talked about the same thing when the low occurred here, and we had traders that took that trade. They made money in that trade. And I'm sure, in fact, I do know of one trader that took this trade against the low of this day, 1167 spot 10, and obviously rewarded. I don't know if that trader is still in the trade or not, but look where we are. We had a tremendous up day on the 24th last week. We got to and through the 20-period moving average, and here we are with some follow-through. We're at a natural area of resistance. As you can see, it's a former breakdown area. So the market broke down. This is a breakdown candle. So we're testing the high of a breakdown candle. What do markets like to do? Test former breakout and breakdown areas. What are we doing now? Testing a former breakdown area. What did we do before? When we first tested the first breakdown candle, right? And the market pulled back a little bit, but then we shot up on Friday, and now we tested today the next in line breakdown candle. Folks, this is a snippet of the stuff that I teach in my course at Lazy E-mini Trader. This is how the market works over and over and over again. Sometimes the patterns tell us a high probability price move is going to occur. That's what the money flow is telling us. Sometimes we can see it. Sometimes it's low risk. Sometimes it's high risk. And sometimes we can't see moves like that coming from Friday. I didn't see that move coming. If I saw it coming, I would have been the first to tell you. I didn't see it coming. It was a tremendous move. We're at a natural area of resistance right now. I still wouldn't be short or long the gold market. I don't want to be long after a move like this right up into a resistance area, and I'm certainly not going to be short getting above in this one fell swoop, for the most part, the 20-period moving average with some follow-through. So right now, I'm just watching. Maybe gold puts in a pattern that we can trade from. Still watching, just an umpire, balls and strikes. Crude oil, 68.79 is the line in the sand. Right here is the breakdown candle. The high is 68.79. You can see we did not close above that high here on the 24th. On Friday, the closing price was 68.72, and here we are above that number, 68.95 as we speak. If the official close of the day is above the high of the breakdown candle, then we'll likely see some higher prices in crude oil. We're above the moving averages. It's still relatively bullish, at least from a shorter term perspective, in crude oil right now. Last thing I want to show you is the weekly chart of crude oil. And just so we understand where we are, we had an important weekly close 2 weeks ago in crude oil. There's a couple of breakup candles here. Now, we closed below one of the breakup candles, but look where we are now. We're back above the 20-week moving average. Could this be a pullback pattern, and could we have higher prices once again deeper into the hot zone? Watching crude oil, it's too early to tell, but the first order of business is, are we going to get an important close right here, right now? Where's the next one? It won't all happen in one fell swoop, but we still could have bullish behavior ahead of us in crude oil. And with that, I'm definitely at a win tonight. I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.